Hello, everyone. I'm Katrina Scott, Chief Investment Officer for Mariner Wealth Advisors, and I'm here today with two of my colleagues, Bill Greiner, our Chief Economist, and Jeff Krumpelman, our Chief Investment Strategist. As you might expect, we've had numerous internal discussions these past several weeks during the ongoing coronavirus challenge and the roller coaster mood swings and just the swings period in the market. We've reached out several times to you in fireside chat format, and we want to continue to do this through these moments to keep you updated on our latest thinking. I guess you'd have to say that it was fitting that last week ended on Friday the 13th based upon the trading activity we experienced throughout the week. It truly was historic in nature and for the most part not fun. Last Monday started with more than a 5% drop in the market at open that triggered circuit breakers not employed for decades to halt trading for 15-minute intervals and hopefully calm volatility. Despite these helpful measures, the week included the largest single-day decline in the S&P 500 since 1987. A one-day swoon of roughly 10% on Thursday the 12th that left this index down approximately 27% from the peak on February 19th and off north of 25% on a year-to-date basis through that Thursday close. We experienced 4 consecutive days of swings of 5% or more in the market last week, which is continuing even today. On the good news front, the market did end the week on a quite positive note as the S&P 500 surged almost 10% that day to pare losses to only 10% for the week. The Friday rally demonstrated the potential whiplash we strive to prevent our clients from experiencing during times of fear and stress. At these times of uncertainty, downdrafts and market declines can be swift and more severe than we like, but rallies can be equally volatile and unpredictable, especially in an environment like today where last week's sharp declines were primarily inspired by psychology and fears of the unknown rather than a typical business cycle train wreck. The market saw its worst day in 40-some years on Thursday, not because of news of a likely sustained surge in unemployment or a probable sustained decline in earnings, but because of things like orders not to travel to Europe for the next 30 days, suspension of the NBA basketball season and other major sports events, and temporary school closings at both the college and K-12 level. These are all things that indeed will lead to a significant and swift decline in economic activity in the U.S., but we think they should actually be seen as a positive by investors and the public because ultimately they address the solution, limit the spread, and smooth the adoption rate and the total magnitude of the coronavirus uptake in the U.S. These measures, along with follow-on steps on Friday and into the weekend, are all voluntary measures that illustrate the seriousness with which Americans now take coronavirus and their recognition of prudent social distancing steps we need to be embracing to ensure this is a 2-month experience in this country, not a multi-quarter, multi-year type of thing with a more permanent economic impact. This is a positive inflection point in our view. Other encouraging signs developed late in the week and over the weekend on this front, including the president declaring a national emergency, thus unleashing $50 billion to support distribution of additional test kits and support for healthcare teams, as well as an agreement for a bipartisan congressional bill to provide relief to U.S. corporations and consumers. These helpful policies, along with central bank stimulus and the volunteer measures I mentioned before, are exactly what we needed to see to jumpstart the journey to stabilizing the disease in the developed markets and to help form a bottom in U.S. stocks. Last night, the Fed announced that rates will essentially be cut to zero, and a $700 billion quantitative easing program will be launched. Even so, the market triggered another trading halt this morning, which to us suggests investors are still waiting for more data around the coronavirus spread before jumping back in the markets. With that as a backdrop, Bill, Jeff, and I will share a brief Q&A session with you today to give you an update regarding our views on the progress in curbing the coronavirus spread, the associated evolving risk of recession, our assessment of the implications for the financial markets from here, and finally, how we are managing through this on your behalf. So, Jeff, let's start with you. I'd like you to quickly discuss our research on coronavirus spread itself and how that's trending.
Sure, Katrina. Well, as we've seen over the weekend, while the spread is beginning to accelerate and we're kind of riding that rising curve in the U.S. and other developed markets in Europe, we have good news in China and the Asia areas like South Korea where this all began. So there's progress on that front. There's virtually no new cases in these regions right now on a daily basis. And, in areas like South Korea, the mortality rate where they've gotten these testing kits out there is more like flu, as is Germany's experience. So that's kind of good news. And it illustrates that if taken seriously, coronavirus can be managed effectively and relatively quickly. Now, Dr. Scott Lieb, who is the former head of the FDA, and he's been out in front on CNBC and doing a lot of interviews, he has said in previous days that this should only be a 2-month issue, and he was out there again today saying the same thing, that this looks to be over in the U.S. in late April or early May, and he was very complimentary of the steps that governors in the United States have taken just over the weekend, and really becoming more serious on social distancing and healthcare responses that we're making here in the U.S. To raise the probability that we have a swifter return to normalcy and get through that, limit that curve and get through it by the late April, early May period. And I think the positive take on what's going on, while these measures will ensure some short-term pain here economically, the fact that U.S. policy leaders, Fed actions that you cited, the fiscal policy measures and so on and so forth, and these social distancing measures, all these constituents are coming together. And in a way, it's refreshing and somewhat similar to what we saw in the post 9/11 period in this country, where we were unified. So the above collective efforts on our mind with regard to progress on coronavirus will help raise the probability of swifter recovery. And these are things that should be cheered, not booed, in our view.
Thanks, Jeff. Bill, I think that's a nice transition to you and to have you talk about how will these steps to address coronavirus impact the economy. Many think we're already in a recession or are assuming we are. And so if you could talk about what our current view is, and if a recession is near, how deep we think it might be.
Sure, I'd be glad to, Katrina. I think to talk about where we think we're going to be going forward as far as economic activity is concerned, we need to remember that we're dealing with a highly unpredictable situation right now, one that an economist or financial people really have a hard time getting our heads wrapped around, just because this is new. This move on the downside in the economy and the volatility in the stock market and the driver that's making all this happen is something that none of us have directly experienced before. We've experienced downdrafts in both the economy and the markets many times in the past, but not with this type of catalyst. But that being said, that's kind of my disclaimer. That being said, we came into the year with the idea that the U.S. economy and indeed the global economy was probably going to be shifting into a lower gear, where growth rates weren't going to be matching what we saw back in 2018 or even 2019. Our call at that time was that U.S. GDP growth was going to slow from 2.3 to 1.5. And the theme that we proposed at that time to our clients and to our friends was flying at low altitude. And that was kind of the theme that we're looking at. And within that theme, we suggested the probability of recession was probably going to be greater for a number of reasons, but probably greater than normal as we entered 2020. Now, that being said, we think in general, if we look at what's going on in the world outside the United States, if you look at China, if you look at Japan, if you look at Europe, particularly Europe and Japan, those two economies came into the year with growth rates of right around 1%. We came into the year with a growth rate of 2.3. China, by measures according to the folks at J.P. Morgan, are showing about a negative 4% GDP growth rate for this quarter we're in right now. So those areas, those three areas, China, Japan, and Europe, are really struggling economically right now. And those three areas in combination with each other represent a little bit more than 40% of worldwide GDP activity. So if you have 40% of the world basically that's already struggling before you even start to count areas outside the U.S., we would suggest are probably at higher risk of experiencing a recession during this year than the U.S. proper. So that being said, we feel that U.S., the probability of us slipping into a recession is real. We recently wrote that we think it's probably above 50%. And indeed, there was a poll that was just done over the weekend by CNBC with Fed participants, Federal Reserve participants, and the Fed believes basically through that poll that there's about a 67% chance that the U.S. is going to be in recession sometime this year. So I think in general, we're looking at something north of 50%. And indeed, globally, we're probably going to see some degree of recession occur on a global scale outside of the United States. The pain with this recession, if it does occur in the U.S., if it does occur, is probably going to be fairly swift. And with the driving factor probably being what happens with the employment picture. Are companies going to start laying people off? I think this is really kind of the cutting edge issue that I'm looking at over the next 30, 60-day period of time as to whether people are going to be really laying people off or not. How deep will the recession be? As I said before, I think it's going to be fairly swift, but I have really no idea how deep it's going to be, nor does really anybody else at this stage. But looking back over the last three recessions and kind of comparing this to the last three recessions and setting some kind of a thought in our minds, the GDP contraction of the three previous recessions have been negative 3.9% during the big recession in 08 and 09, minus 1.3% in the recession in the year 2001, and then minus 2.8% in the recession in the year 1990. So you take those three and you add them and you look at kind of the average number, and we would suggest that if we do fall into a recession, it's probably going to be kind of a mundane recession as far as the actual loss is concerned. We would suggest the number is probably going to be somewhere between 1.5% and maybe all the way up to 3% in significance. And so the 1990 recession saw earnings decline by a fairly significant amount. Earnings declined in 2008 and 2000 by negative 48 and 23%. And so our view is that if we do fall into recession, we probably are going to see some degree of earnings contraction along with GDP contraction as we move forward. But again, I think the jury is still out on this issue, and really the duration and the depth of the recession, if it does occur, is probably going to be driven by and is going to be reflected by job losses. And again, I don't think we're going to start to see a lot of that as we move forward anytime soon. NFIB, National Federation of Independent Businesses, which is kind of a measure of small business sentiment and small business attitude, this is a key factor as we go forward. Their sentiment data is released on the second Tuesday of each month. And so the next release is on April 14th. That day is going to the poll will come out, and small business people are going to be voting, saying, yes, we're very bullish, we're very bearish on the overall economic environment, and we plan on hiring or firing people. I think that's going to be a very important release that day. Remember that upwards of 70% of job creation is created by companies that employ fewer than 500 people. So small business attitudes and small business sentiment is really key as to the duration and magnitude of the recession. And I think we're set on that right now.
Thanks, Bill. So maybe just to summarize what you just said, I think that basically the jury's still out, but we could assume that U.S. is probably going to be in a technical recession, but that in your view, this could be maybe the shortest and shallowest we've ever seen.
I think so. I think it is going to be.
Okay.
Yeah.
Thank you. So Jeff, maybe you could talk a little bit then if that's kind of the current state and that's what our view is, how are we going to manage through this?
Sure. And I do think that that's the punchline here in terms of, the speed, relatively mild compared to some of these other recessions and the swifter kind of trajectory here. And I think what we see is, and this is key, the market cares more about trend, which includes getting less worse than it does about absolutes. We know it's going to be painful short term, but if things begin to get less worse and begin improving as we move through the end of the year, that's what the market's looking for, and it will discount that in advance. And one of the eras that I'd just like to go back to, Bill and I and you have talked a lot about how this is not a structural train wreck here like we saw in 07, 08 during the subprime lending and housing collapse. This is self-induced quarantine that is painful short term, but it's not the same thing as the economy was a mess kind of going into this. And it's not like 2009, speaking about whiplash and how you need to be careful to avoid whiplash in this. It wasn't like 2009 the economy was just a wonderful thing as we saw a 26% return in that first year of recovery. We were losing 700,000 jobs a month in the early part of 2009. And it's not like all of a sudden we started gaining 700,000 jobs a month. We went from minus 700,000 jobs that we were losing to minus 500,000 to minus 400,000 to minus 200,000. By the end of the year, we weren't losing jobs. So it's just the fact that the market could see that things were getting less worse, and then eventually they stabilize and get better, and it gets ahead of that. So, today we got news out of Italy, for example, the Lombardy region, that new daily cases of coronavirus have been at the lowest level in more than a week. And it will be news flow, like that, plus policy responses to kind of cushion the downside, and news that things are getting less worse than new coronavirus cases in the U.S. that will allow the market to move ahead of pure economic euphoria out there. And so we want to be careful of avoiding this whiplash as some of these positive news flow items occur after we get through this late April, early May period. And so we've had a very balanced approach to manage through this. There are a lot of folks that are saying, you ought to run to pure defense, and this is going to be longer and lingering. And then you get, the other folks that are uber bullish, and they're saying, no, go to cyclicals. This is the time to get really aggressive. And we don't think that either of those are the right side of valor. We think that, poise and balance and a diversified approach is the key. So we're holding our ground. We're not selling. We don't think that's the right to do this deep into, the correction for sure, the swift correction. Hold your ground because wonderful value has been built in companies that we own with strong balance sheets and consistent earnings growth. And we're upgrading where possible because the baby has been thrown out with the bathwater. It's not like just certain pockets of the S&P 500 have been punished. They've all been punished. So we see some real opportunities to upgrade and maintain balance. In terms of, where is the bottom? I think, Bill, all of us would say, and it's a fool's errand to try and pick the exact bottom. But what we do know as analysts is that the market will discount forward what happens to the economy, and that we see intrinsic value in very attractive companies that we think when looking out over the next 12, 24, 36 months, this is just a marvelous time to be looking at these opportunities. So, I think hold your ground is important and take advantage of opportunities knowing that there could be some additional downside, but we think that this is really a good time to upgrade.
Makes sense. So, Bill, before we've kind of covered where we see things today, how we're managing through it. Before we put some things into a historical context, I do want to get your thoughts on one last thing before we move away from kind of the recession topic. Is there anything from your point of view that could keep us out of the recession at this point, and kind of what are you looking at from that perspective?
I think it really comes, Katrina, down to how long the virus is going to continue to spread in the U.S. And as data, we see data that the viral issue is starting to abate and the number of new cases is starting to slow, then I think in general the economy is going to start recovering and bottoming and recovering. I think also that, as I said before, if job losses don't occur, if people still have income and people still spend money, the severity of the economic downturn and the length of it is going to be much shorter and much more mild than would otherwise be the case. So I think job creation is key. We as a society are already changing how we lead our lives, and everybody knows that through the announcements that were made this weekend, and how we're basically functioning on a day-to-day basis. We will travel less, spend less on discretionary items, entertainment, and anything that leads to big gatherings of people will slow dramatically, as we all are aware now. This is on top of the potential declines in consumption activity, which normally accompanies a rise in the unemployment rate, which I think we're going to see a little bit of. But I think that's really the factor that I'm most interested in going forward is how does the job market react to this whole issue? As I said earlier, small business sentiment is going to be key going forward. And I think that's really kind of the cutting edge issue. If small businesses don't lay off a lot of people, if we don't see significant levels of layoffs and newly unemployed folks filing for claims, and those numbers stay relatively mild, then I think in general the downturn is going to be fairly swift and not all that significant one way or the other. But on the other hand, if the unemployment rate starts to push to the upside in a meaningful way, people may start running for cover.
Yep.
That's kind of what I'm thinking right now, Katrina.
Thanks, Bill. That makes sense. So now I want to switch gears a little bit and focus more about putting the recent market action kind of more into historical context and some of the other time periods that we've seen before. And Bill, you've done a lot of great work on historical periods and recoveries from prior periods after the downdrafts that we've seen of this magnitude. So what can you share, and can you talk about how this compares to what you experienced in 1987 and 2008?
Sure, I'd be glad to make comments like that. I think it's one of the blessings, I think, of being at my age level. I've been in the business for 41 years now, and I've seen a lot of downturns similar to this, and a number of recessions, and lived through them all, and lived to tell the tale, and also lived to see higher stock prices after each and every recession that I've seen over the last 41-year period of time. Eventually. One of the things that I found stunning about this move on the downside is how rapid this downside move unfolded. It's a record. It's looking back in time, according to Barron's magazine, going back since the first of the 20th century. I'm sorry. This move on the downside, the 20% loss we saw during the last few weeks, was the most rapid 20% loss the market has experienced really in almost history. The 20% downside move, the start of the bear market, took 19 days, 19 trading days to unfold. The quickest one before that occurred in 1987, and that was 38 days. Many of the listeners to this recording are going to remember those days also in 1987. But that 20% move on the downside took twice as long to unfold as did the downturn we've just come through. But looking at that in relation to 1987, as far as what was going on fundamentally in the economy in 1987, what kind of factors led up to that decline are somewhat similar to what we've seen now over the last month or so with this current decline. U.S. stock market movement has reminded me again of what happened in 1987. Recall the following facts from 87 as compared to the same factors today. Number one, 1987, the economy was experiencing its fifth year of economic growth following the end of the 1982 recession. At that time, back in the 1980s, the fifth year of an economic expansion was considered a fairly late stage in overall economic activity because you normally had 4 years on, 1 year off, 4 years on, 1 year off as far as time between recessions. That was the fifth year of that economic cycle, and people thought it was fairly late. We've been suggesting over the last year or two that we're in the late stage of the current economic cycle. So that's one similarity. Another similarity is business credit creation in 1987 was very, very strong. And you recall back in the days, that was the days of the leveraged buyout opportunities, the LBOs and management-led LBOs and so on and so forth. It was very, very strong during that period of time. This cycle, non-financial corporate debt has risen to $10.1 trillion with a T, a level equal to 47% of GDP. That's a new all-time high. So business credit creation is very similar this cycle where we are right now as compared to 1987. 1987 was 1 year away from the presidential election of 1988. 13 months to be exact is when that crash occurred. This time around, we're about 9 months or 8 months away from the next presidential election. Point is, we're within 1 year of the next presidential election, which was the case back in 1987. During the 87 crash, Alan Greenspan had just taken the reins of the Federal Reserve chair. The Fed stepped up and provided huge levels of liquidity during the 87 crash, very similar to what Chairman Powell is doing just right now, lowering interest rates to zero, trying to infuse tremendous amounts of liquidity so that solvency within the banking system is maintained, and that's exactly what Greenspan was trying to get accomplished back in 87. The world's investors were in shock in 87, as is the case right now, which normally speaking, when you see a 20% move on the downside in 3 weeks, you'd expect people to be in shock, and we're certainly seeing that right now. So there was a lot of similarities that led up to the 87 crash that were similar to what we saw here within our economy, and right prior to this crash we've just come through over the last 2 or 3 weeks. I think that the kind of the punchline with all this is in 1987 the crash unfolded fairly quickly and it started to recover fairly quickly. In which I expect if this downturn we're seeing, the economic downturn, is swift, we'll probably see the same kind of reaction here within our current market. 2 years following the 1987 crash, the stock market was up more than 50% over that 2-year period of time. Now, the economy didn't go into recession during 1987 until 1990, but nonetheless, the stock market did recover and recovered back up to the old highs within a 24-month period of time following the 87 crash. The point with that is, if this is similar to the 87 crash, we have historical standards to suggest that stock prices will eventually get back up to where they were prior to the start of this downturn and set new all-time highs in not too distant future.
Thanks, Bill. I think your point on that, while the sell-offs can be dramatic, the rallies can be hard and swift as well. So thanks for putting that in perspective for us.
Yep.
Jeff, I have had some people say that the last time they felt this kind of fear, just fear in society, was around 9/11. So what's your perspective after managing through that time period of uncertainty and fear, and how you can take some things from that and apply it to current state?
Yeah, I think your question, Katrina, as well as Bill's, excellent kind of commentary just there about 1987, again, demonstrate why our position is poised, diversification, hold your ground, upgrade, and focus on strong companies with strong balance sheets right now, and there's opportunity. With regard specifically to 9/11, just around that event, so many people today are saying this is unprecedented. These are unknowns that we've never seen the likes of before, and so on and so forth. And it is, there are a lot of uncertainties here, and there is fear around certainly health issues. But I just throw out as an example of another time where it was unprecedented. There were different fears, different issues, but it was unprecedented. And it's just fascinating what the market did, and is an example of why you want to avoid whiplash around these time periods like this, and not just cave in to fears and sell. So around 9/11, what happened? I think we forget that the New York Stock Exchange closed. It was closed for several days. The airport shut down, and we have a Broadway play called Come From Away, where you had 35 some flights landing in Flanders, Newfoundland, because they couldn't get back in the United States, international flights that flooded that part of the world for days. People were stranded there. We were worried about anthrax, and we certainly wondered if there would be more attacks. But what did the market do around this uncertain time? Well, it was off 14% in the week after this unprecedented period around 9/11. It was off 20% plus from the beginning of September to several weeks after the attack. But within a month, we were back to those 9/11 levels, and the market came back swiftly in that 30-day period. So it's an excellent example of, not mistaking activity for progress around these periods. Now, I have to say, eventually the market did go into recession later, and that was a result of the bursting of the technology bubble in full form. And we have other issues out there. There's concern about, a potential energy crisis, if you will, because of what's going on with Saudi Arabia and Russia and so on and so forth, that we really don't even need to bring into the equation now. But we'll continue to monitor that. But given the facts as we know them today, and with this unified effort to build a bridge, we do think that this could be of the milder form if we do practice social distance, and with the support of the Fed and fiscal policy. I think that all of this helps shorten the curve of the peak magnitude of coronavirus here, and helps lift the probability of more of a U-shaped type of economic and market recovery. And so 9/11 is a marvelous example of how things can change very swiftly. I'll leave it there on that front.
Thank you. I think that both of you shared some things for everyone today that can help us kind of keep a focus more on the long term, even though these turbulent weeks are not fun for any of us. So we hope that this gives everybody a little bit of a sense for where we are and how we're managing through. Our plan is to continue these dialogues and sharing facts and additional news as they develop. So we thank you for listening and stay tuned.